This program was first broadcast on Canterbury's access media station, Plains FM, and was made with the assistance of New Zealand On Air.
Welcome to your weekly dose of the Accountology Show. I'm your host and chartered accountant, Nicole Hague, with an insatiable curiosity for uncovering accounting ideas to help businesses grow. I have so many nuggets of gold to share. Are you ready to make your good business great? Let's get stuck right in. Hey, it's your host Nicole Hague, and welcome to another episode of the Accountology Show. In accounting news, perhaps as no surprise, the New Zealand Budget 2024 announced by Finance Minister Nicola Willis on the 30th of May 2024 was a relatively boring budget with no surprises. Described by Tova O'Brien as Budget 2024 is the beige budget, as expected. Tax cuts were the centrepiece of this budget. They were almost entirely as advertised on the campaign trail. But one of the most significant updates was the increase in personal income tax thresholds. From July 31st, 2024, the thresholds for the bottom three income tax rates are increasing. The 10.5% rate now applies up to $15,600, the 17.5% rate up to $53,500, and the 30% rate up to $78,100. This adjustment is a modest step, given the wages have increased by 63% since these thresholds were set last in 2010, but it provides some relief for individuals, ultimately benefiting the wider economy. For those earning between $24,000 and $70,000 per annum, the independent earner tax credit is extended. This tax credit now offers $20 per fortnight for eligible earners, with an abatement starting at $66,000. This means more people, especially those on minimum wage working full-time, can now benefit from this credit. Families with dependent children will see an increase in the in-work tax credit and the minimum family tax credit. Starting July 31st, the in-work tax credit will go up by $50 per fortnight and the minimum family tax credit threshold will increase slightly. Although these increases might seem modest, every bit helps, especially when combined with other family-orientated measures. However, if you have a student loan and are living overseas or planning to move abroad, there's a 1% increase in the interest rate on those loans starting 1st of April 2025. This is intended to offset the impact of inflation on outstanding loan balances. The government is boosting Inland Revenue's audit and investigation capabilities by committing further funding over the next 4 years. The additional funding is expected to strengthen audit activity with particular focus on the hidden economy and debt collection. In addition to these personal tax measures, it's important to remember the government has already enacted several significant tax policies promised during the last election. These include restoring interest deductibility on residential investment properties and taxing overseas online gambling operators. While this budget might not be revolutionary, it's a step towards economic stability and support for families and individuals. Do you understand the difference between profit and cash? Are you improving your profits but not seeing an improvement in your bank balance? In today's episode, we'll delve into the intricacies of bolstering both profit and cash flow, recognising them not as equal terms, but as interconnecting components vital to the success of any business. Uncover multiple approaches to amplify profit and cash flow simultaneously, empowering you to make informed decisions that propel your business going forward. Join us as we navigate through proven strategies aimed at driving your business towards increased profitability and robust cash flow. Are you a business owner struggling with profit, cash flow, or to find balance between work and life? At Nicole Hague & Associates, we want to help business owners just like you reclaim your freedom. Freedom to spend quality time with loved ones, freedom from stress, and freedom from financial burdens. But how do we do it? It's simple. We listen, we understand, and we create bespoke, structured programs tailored to your unique business and personal goals. With the right education, coaching, and expert advice, we'll show you how to increase profits, improve cash flow, and align your business and personal goals. Don't do it alone. Let NH plus A be your guide to success. Work smarter, not harder, with our proven accountability methods. Your freedom starts here. Contact us today. So, do you understand the difference between profit and cash? If not, we have a lot of blogs and videos on our website on the difference between profit and cash. Or just stay tuned here for more information. So I've worked with a lot of clients, and so often there's a misunderstanding that profit and cash are the same things. Maybe you're improving your profits, but you're not seeing any improvement in your bank balance. So the big difference between profit and cash is that cash is not profit. Cash is king. It's the lifeblood of any business. A business's purpose is to make money, right? So you must know the difference between profit and cash flow. So let's look at net profit. So net profit is what you have left over after you deduct all your business expenses from your revenue. You change your net profit only by changing the things that affect business sales or your revenue and business expenses. So for example, you negotiate with your suppliers, you may get stock cheaper or carry less inventory, maybe even consider a floor plan with your supplier or consignment of stock. Your staff engage with customers better so you can learn more about what they do and don't like and get more business. Or you can roster staff differently. You may be able to run your business more efficiently. Cash flow comes from various sources. However, it does also cover your operating expenses, taxes, equipment purchases, loan repayments, drawings, and so on. It's basically anything that goes through your bank account. But remember, a profitable business does not always have good cash flow, and a business with good cash flow is not always profitable. And we've talked about this in previous episodes. Your business can't survive without cash. So here's a few takeaways essential for business success. Protect your cash position by knowing what it is. Build a cash flow statement and always keep it up to date. If you foresee a shortfall, start to fix it at once. You can create a cash buffer or a cash reserve as an insurance policy against unexpected difficulties, and we've all seen enough of those lately. Protect your cash position against revenue shocks by maintaining a balance equivalent to at least 2 months of operating expenses. And by that, I mean, if your sales were down considerably from your expectation, that what you have in your cash reserves set aside, it should be at least 2 months of your operating expenses, so then you can continue to operate. Be realistic with revenue expectations, because if you're unrealistic, it'll result in disappointment and the feeling of failure. And we don't want to set anyone up for failure. So take action now if it looks like your sales are not going to get you to break even. We've got some tips later in the episode of what take action now could look like. Customers want purchases on credit, right? Credit checking upfront will reduce the risk of customer non-payment. So make sure you follow up with clear payment terms agreed in writing. Communicate regularly with customers and automate where possible. So for instance, Xero has a feature where you can set up automatic email and sequence to be sent out to customers who are overdue in the payments due to you. And every dollar you spend reduces cash reserves. So the best way to protect your cash is to create a budget. So then you know what you need to spend and you stick to it. So it's like going to the supermarket with a list. Without the list, you buy willy-nilly. But with the list, you start to question any purchases not on the list and ask, does the business really need that? To work out how fast you can grow your business, you need to look at your projected cash flow. And if you have not prepared a projected or forecasted cash flow before, your accountant can advise you on this. So let's explore the difference, which will help you to make a better plan to increase both profit and cash. So let's look at sales. So profit increases when you increase sales. Cash increases when you collect the money from your customers. To increase both the profit and the cash from sales, here's some examples. So firstly, delight your customers. Generate more leads and referrals. Convert a higher number of quotes or proposals that you prepare. Increase transaction frequency and increase transaction value. Now, if we look at invoicing, profit increases when you send an invoice to a customer. Cash increases when you collect the invoiced amount. To increase both your profit and cash, Set clear terms of trade, offer a small discount for early payment, agree the price in advance, and stick to your payment terms. Don't do work for people who have overdue payments. If we look at your margins, so increasing your margins will increase your profit. Collecting the increased margin will increase your cash. To increase both profit and cash, increase your prices, invoice faster, negotiate better terms with your suppliers, reduce errors and rework, train and empower your team, and increase your efficiency. Now, financing. If you reduce your finance costs to increase your profit, borrow money for assets to increase your cash. To increase your profit and cash through financing, spread the costs of an asset over 3 to 5 years instead of buying them outright. So, for example, if you bought a $50,000 vehicle for the business, instead of paying it outright, that coming out of your bank account straight away, if you spread it over 5 years, that would be $10,000 per year plus interest. See how it affects the cash flow? Borrowing from a bank instead of a finance company because you're going to get better rates. Secure the asset purchases over bricks and mortar if possible, instead of personal guarantees. Overheads. By reducing your overheads will increase both your profit and cash. To reduce your overheads, negotiate with suppliers, measure your return on spending, so for example, your advertising, etc. Review your subscriptions and go paperless. So that's not an exhaustive list to increase your profit or cash flow. There's so many other ways. You can work with your accountant to help you identify specific areas of improvement in your business to increase both the profit and cash. And remember, as Sir Richard Branson said, never take your eyes off the cash flow because it's the lifeblood of the business. So let's look at keeping your business cash liquid and the difference between the cash flow and profit. The fundamental goal of any business is to make a profit. As a business owner, that's one of your key financial aims, to make enough sales at a big enough margin to generate profit from your business. But how do profit and cash flow differ? To really understand the difference between generating profit and managing cash flow, we need to look at what both those terms mean. So you might think that delving into the accounts is a job for your accountant, but being in control of your profit and cash flow is an invaluable business skill. Let's take a look at the differences. So, what is profit? As we've said before, profit is a surplus that's left from your income once you've paid all your business expenses, supplier bills, and taxes, etc. It's driven by creating a profit margin and generating value from your products and your services. Most of these items go through the bank account. However, there are items such as depreciation, which is a non-cash item, meaning that it's tax deductible on your profit and loss statement, but it does not hit your bank account. So what is cash flow? Cash flow is the ongoing process of ensuring that the business has the available cash or liquid cash needed to operate. This provides the money needed to trade, to pay suppliers, to cover your wages, or to buy raw materials, etc. So this will include all your sales and expenses from your profit and loss, but not depreciation, remember. But it will also include business expenses that are not tax deductible, so do not affect your profit. These are normally balance sheet items such as your GST paid or received, drawings being funds that are taken out of the business for personal use, principal repayments made on a loan, so the interest expense is tax deductible. However, if you make principal repayments, this is not tax deductible, so does not go through the profit and loss, but it does go through the cash in your bank account. You buy a business asset. Let's just say it's $1 million worth of plant and machinery for the business. This is not a deductible expense, but it is an asset used to help generate income for the business. So this goes through the bank account and affects your cash flow, but doesn't touch the profit and loss. You borrow funds for the business and the lump sum amount increases the bank account when received, but it does not affect your profit. It's not an increase in the bank account from a sale. But why is positive cash flow so important, I hear you ask? Cash is king. Maybe it's a cliche these days, but it's a rule which underpins any successful business model. Yes, it's great to make a profit at year end, but if you don't look after your cash flow, then the business may not survive as long as the end of the year. What's needed is good cash flow management to enhance your financial health. And without a careful eye on the cash numbers, things can quickly go awry. A business can generate high revenues and big profits, but still be cash flow poor. In other words, it can have profits at the end of the period, but have very little cash to fund its day-to-day operations over the course of the period. Good cash flow management is all about being in control of your cash inflows, so that's the income you're generating, and your cash outflows, so that's what you're spending. To achieve positive cash flow, you need to proactively work to keep your inflows higher than your outflows. Your accountant can help you improve your cash flow management and help you set up detailed cash flow reporting and forecasting so you can keep the business in that ideal positive cash flow position, as well as looking at key steps for keeping your revenues high, margins profitable, and meeting your financial targets. Okay, but what could the first cause of poor cash flow be? So let's look at your cash lockup. What is cash lockup, I hear you say? Having your cash locked up in work in progress or accounts receivable is a key cause for poor cash flow. This is a great example of a massive difference between profit and cash flow. Profit increases when you create an invoice for work that you've done and goods that you've sold. Cash increases when you bank the money. Your lockup, remember that's your work in progress and your debtors or accounts receivable. So your lockup equals the cash that isn't in your bank account because it's either in work in progress, so that's work you've done but you haven't been able to bill it yet, or you have billed your customers but are still waiting to be paid. There are two processes that need to be improved to reduce the cash that's stuck in your lockup. Within each of these two processes, there are countless strategies that can be put in place to make more cash in your bank account. First one's billing. The earlier you invoice a customer, the faster you'll get paid. So you need to ask yourself the question, how quickly after delivering of a product or a service do I bill? Do I carry significant work in progress because my service spans several weeks or even months? And if so, should I consider progress billing on a regular basis? Now, collections. So you've done the work, you've billed the customer, now it's time to get paid. You need to consider these questions to hasten your collection time. Do your customers sign off clear terms of trade before they do business with you for the first time? And are there clear expectations as to when an account is due for payment? Is that 14 days after invoice? Is it 7 days? Shorten up that time frame and your cash lockup will go down significantly. And how easy do you make it for customers to pay? So your invoice and statements should contain a link to pay immediately online, or at least state your bank account details and due date. Do you have multiple payment methods for customers? For example, direct debit, a credit card, EFTPOS, debtor finance, where appropriate. And do you offer a small discount for prompt payment? Customers love discounts. These are just some of the process changes you can consider to reduce cash lockup. There are dozens more. Okay, so let's look at your profit and loss. So when you're in control of your profit and loss, let's call it the P&L, you have a tighter hold on the reins of your profitability as it helps you understand your business performance and profitability over time. Here's our plain English guide to profit and loss and what this report reveals about your finances. Again, we've talked about this in previous episodes in more detail, but let's briefly cover this again. What is a P&L? So your P&L statement is commonly, as I said before, referred to as either a profit and loss statement, a P&L, income statement, or a statement of earnings. Your P&L is the breakdown of your business's revenue, so money coming into the business's sales and other income, and your expenditure, which is the money going out as direct costs, overheads, operating expenses, and other costs. As a business, you obviously want to turn a profit and make money. Keeping a close eye on your P&L allows you to track your revenues and expenses over a set period and look for ways to boost your profitability as a business. Whereas a balance sheet is a snapshot in time, the P&L shows transactions over a specific period of time. This can be a month, quarter, financial year, or any other period, and it can be standalone as a report or a comparative period report. Together with the balance sheet, these two reports provide a comprehensive understanding of the financial position and performance of a business. How does the P&L affect your business? Being in control of your financial management is hugely important for any business. Your P&L is one of the main ways to track and analyse this financial performance. To manage your P&L effectively, it's important to focus on revenue management. To keep your revenue or your income healthy, you need to proactively go about generating sales and monitor your revenue streams. This helps keep your income steady and stable whilst also identifying areas for growth and improvement. Expense control. So tracking and monitoring your operating expenses helps you spot where spending efficiencies could be made. Whether it's overhead costs or inventory overspending, your P&L helps you spot unnecessary costs and boost profits. Cost analysis. So analysing your business costs can help you spot opportunities for saving money, whether it's agreeing a discount for bulk buying or switching to a new supplier with cheaper rates. There are plenty of ways to cut costs and be more profitable. And monitor your gross margins. Reviewing the business's gross margin helps you access the profitability for each product or service. By pushing up prices or cutting your production cost, you can boost those margins to drive up profits. And then financial reporting. Regular preparation of your profit and loss is key to good financial management. Reviewing your P&L helps you access the overall financial performance of the company and make better informed decisions. As we conclude today's episode, I trust that it's been evident that mastering profit and cash is not merely about maximising revenue or minimising expenses. Rather, it's about planning a balance between these two essential business elements in order to drive sustained success and growth in your business. So remember, profitable businesses can and do fail. Profit and cash flow need to be looked at in your business, not only in isolation, but also as one. It's essential you have processes in place to ensure you are all over those numbers, that you have a cash flow forecast and a budget for your P&L, and you review these regularly. Any little hiccups along the way, then you adjust the cash flow and the P&L so you have a fair understanding of where you're going to end up. And if necessary, make quick fundamental decisions to, for example, reduce costs to ensure your profit stays on track, or collect outstanding debtors or invoices owed to you to get the cash straight back in the bank account where it belongs. It's of paramount importance that cash flow management is prioritised and that you, as the business owner, recognise it as the lifeblood of sustained business growth. Okay, 3 action points. The first one is prioritise cash flow management. Make it a top priority to monitor and manage your cash flow meticulously. Implement strategies to accelerate cash collections, streamline invoicing processes, and negotiate favourable payment terms with suppliers to ensure a healthy cash flow. The second is implement profit-boosting strategies. So focus on enhancing profitability by optimising sales processes, increasing transaction frequency and value, and negotiating better margins with suppliers. Additionally, consider innovative ways to reduce overhead costs and improve operational efficiency to bolster your bottom line. And lastly, seek expert guidance and support. So don't hesitate to leverage the expertise of your accountant, financial advisor, or business mentors who can offer valuable insights and guidance tailored to your specific circumstances. Collaborate with them to develop a comprehensive financial plan and identify opportunities for growth and improvement in both profit generation and cash flow management. And if there's one thing you should take away from this conversation, one aha moment, it should be the profound understanding that while profit and cash flow are distinct, they are equally vital pillars of business success. Recognizing the prioritizing cash flow management alongside profit optimization is essential for sustainable growth and resilience. By mastering the balance between these two elements and implementing strategic initiatives in place, you can pave the way for enduring prosperity in your business. Thanks for joining us on the Accountology Show. If you have enjoyed today's show, you're in luck because we'll be back next week. You'll find past episodes at plainsfm.org.nz and subscribe on Apple Podcasts or Spotify to never miss an episode. We would love it if you would leave a 5-star review and tell a friend or business owner who would benefit from hearing our show. We also love hearing from you, so reach out with any comments or a topic you'd like covered, and even suggestions for whom we should get in the studio next for an interview. You can find us on Facebook, Instagram, LinkedIn and TikTok. Our handle is NH Plus Associates, that's NHPLUS Associates, or email me, nicole@nh-a.co.nz. But most importantly, thank you for taking the time to listen to the show. Until next time, keep building that business into the empire it absolutely deserves to be.